Hey, we are on. Welcome to the Real Money Pros. After, about a week off, we're back here again. Same time, same place, here for you. I'm Jeremiah Bates. She is Alexandra Lundgren. We are fiduciary financial advisors here to talk about anything you have top of mind in your financial sphere. If you've been listening to this program or if this is the first time you're hearing it, got to make it clear, we're not here to sell anything. We are a sponsor-driven program. We're here to provide education. The more educated you are, the better decision-making protocol that you have in your toolbox. And you also understand dynamics in the market. You understand tax efficiencies. You understand where certain allocations actually fit in your overall plan, meaning it's not this haphazard shooting from the hip or some pitch on some product that is the end-all, be-all, and will fix everything in your financial picture, especially in retirement, where you won't lose any money, but you'll also get gains, and you're guaranteed this and guaranteed that. You got to be leery of that stuff. And bottom line is we're here to help you decipher those things, look past the myths, look past the muck, if you will, to arrive at, hey, you're a real person who's got a family. There's things that are important to you, and obviously your financial picture is going to make you, it's going to be a source of peace or it's going to be a source of stress and anxiety. So we're here to help you clean up a mess. We're here to talk through, hey, how do you keep more in your pocket from tax efficiencies? And also, how do you avoid traps? It's funny, like one of the big topics that we're going to hit on today, Alex, is understanding taxes, especially when you are in retirement, because there's this old adage where if you are younger, you're in your higher income earning years, you're working, gathering a wage, that, well, I'm working, and which means I'm making more income, which means I'm paying more in taxes now than I will when I retire, because when I retire, I'm not working, which means I'm not getting income. So in theory, I will be paying less in taxes when I'm older and retired than what I'm going to pay right now while I'm earning more income. That is the general consensus. And obviously, I'm painting with broad brushstrokes here, but you get the point. And I'm here to say that there's some myths behind that. There's a little bit deeper dive that we need to get into and get into the education, the logistics, the moving parts of actually how you recognize taxes, even though you've cut the corporate cord or you sold your business. Because if there's one thing I want to make extremely clear is that when we're talking about headwinds, expenses, things that are going to work against your resources as far as quality of life impact in retirement and even before retirement, it is the burden of taxes. It's very surprising for many of my clients that I meet with or new clients where, we're doing their projections out. And
right.
If there's one thing that we make a point of is, hey, we're looking at the lifetime picture of your tax obligation. We're not looking at it in 2026. Okay, now that's done. Now let's look at 2027, meaning we're not looking at each tax year on an island on its own.
Right.
We're looking at the lifetime of your taxes. And it's a pretty significant number when you look at that number that we're projecting of your lifetime tax obligation. It's quite an eye-opener.
Yeah, it's usually the biggest obligation anybody has in their lifetime, even quite often exceeding anything medical, just because it never goes away, right? It's always there. And sometimes what saves you money this year costs you money down the road. So you have to decide not just, how much do I want to pay now, but it's like, when do I want to pay the taxes if I'm not going to get out of them?
It's not about what you earn, it's about what you keep. So when you're in retirement, the idea of being tax efficient is that you're keeping more money in your pocket at the end of the day and sending less to the IRS, sending less to your state taxing authority. As much as I would love to know that every single tax dollar is being responsibly spent and responsibly used, we don't need to go down that path, but I think a lot of people are hearing that and agreeing with me that historically now and in the future, there will be misuse, pretty obvious misuse of our tax dollars. So that's where we are of the adage, don't pay more in taxes than what you have to.
Right.
So let's find efficiency and just don't fall into these traps. I mean, if you're out in the woods and you're hiking through your life through the woods and trees and potential traps. I mean, obviously, if you see a bear trap, it's going to be pretty obvious, pretty big. It's going to probably have a little sheen or shine to it. You step around it. But if there's a pit covered with leaves, yeah, everything looks safe until all of a sudden you fall into it. Quicksand, a snare, like getting lost on the trail, getting turned around, right? It's a lot of times this is unfamiliar territory, but most traps don't catch people because they're weak or, just don't have the mental capacity. It's because they never realized the trap was there. So
absolutely.
Awareness is the first step, which obviously we're going to cover. And then obviously we'll cover the execution of awareness. It's like, okay, now I see it. I understand it. So now what do I actually do? And the doing, I think, is probably the most extreme part. So let's get into it.
Well, I think the other thing that makes it different in retirement is you now suddenly have not just a paycheck that you're trying to figure out taxation on, or maybe a paycheck and a little bit of interest from a savings account, and should you put in your 401k. Money is coming from places that are taxed differently. And then also, now you have to figure out, okay, there's a table for this and a different number for that and a different number for how much I pay for Medicare and a different number for this, and trying to coordinate the different sources and the different tables. That's a lot.
It is.
And especially if you don't even know some of them.
Yeah, and that's the kicker too. Like, I can't tell you how many times I've heard this said during this year is, there's no tax on Social Security. So what's going on with that? And it's like, okay, well, no, that's not the case. Your Social Security certainly is still taxable, meaning when you are looking at all of your sources of income. So let's just paint a picture of retirement, where generally speaking, you're going to have Social Security at some point. And we're going to talk about this the next hour. We are a live 3-hour program. We are going to dive into Social Security for hour number 2. But for most individuals, you're going to take Social Security, maybe as early as 62, maybe delay it as age 70. But Social Security will be an income source.
Right.
And that's a whole separate conversation when we talk about actually how the taxability of Social Security is actually calculated and how it flows through to your actual tax return. But let's just use easy numbers. At most, 85% of your total Social Security benefit will flow through your tax return as actual taxable income. So if you're getting, let's just imagine you're getting $100,000 of Social Security and some crazy quasi land. I don't know. If you fast forward the clock and look at the cost of living projections, married household, following of 2. Hey, in your advanced stages, wouldn't be surprised if you have around $100,000 of Social Security.
Right.
Talking with inflation growth, cost of living adjustments. But just to point the numbers out, if you as a household, you're receiving $100,000 of Social Security, only $85,000 would actually flow through your tax return as taxable income. So that's one source of income. Maybe you have a pension. Mm-hmm. Okay, so that pension, that'll be taxable as income as well. Now, what if you're doing IRA distributions?
Right.
That will be taxable as ordinary income. And it's important to understand the ordinary income because that is what's subject to your marginal tax brackets.
Right.
And the marginal tax brackets depend on what's your filing status and what's your overall and what's your income. Like, meaning we got 10%, 12%, jumps all the way to 22, then it goes to 24, then it goes to 32, then it goes to 34. So you see the trend there.
Yeah.
So again, painting this retirement picture. So you have Social Security, pension, you're doing IRA distributions, and
what if you sell some stock and take that money?
So now we're getting into the non-qualified side of things, where let's imagine that you opened up just a brokerage account, you were buying some stocks, you bought some ETFs, some mutual funds. Any activity that happens inside of that account throughout the year, I don't care if you sell something or you buy something, meaning if it's just in there and it's generating a dividend or it's generating interest, that will flow through your tax return.
Yeah, even if you don't take the money out of the account.
Now, that's entirely different from an IRA, meaning you could have a stock that generates $100,000 of dividend income inside of an IRA or a Roth IRA for that matter. Nothing taxable to report. The only time you actually have rubber hitting the road as far as a taxable event is when you do the distribution out of the pre-tax IRA.
Right.
But in the non-qualified account, completely different. Meaning this is just an account that you own in your name. It doesn't have the Roth designation. It doesn't have the IRA designation. Maybe you and your spouse own it. It's a non-qualified account. Or maybe it's even in the name of your trust. Any dividends or income that's derived off of that'll be reported and you got to put that on your tax return. If you sell something at a gain, that will be taxable to you as well. So you can see that we're kind of painting this picture here for you to understand, okay, hey, I have these. I have a pension. I have Social Security. I have a retirement account. I have a non-qualified account. How do these all coordinate together for my taxes, and how do I reduce it? That's what we're going to talk about when we come back. This is The Real Money Pros. Stay with us. Welcome back to The Real Money Pros. Again, we are live here for you, fiduciary financial advisors, fiduciary financial advisors here at your service.
Tongue twister.
Oh, yeah, too early on a Saturday morning. Phone lines are open, 979-59-MONEY. That is 979-596-6639. You can send us a text message to that number as well.
Yeah, and I have to tell you, we can't be the FFA. That's already claimed. I'm out in the West. I grew up out here, so I actually know what that is. But we can't be that.
Nope.
It's a whole different thing.
Nope, absolutely. Again, visit therealmoneypros.com, one of the best way to get access to our educational content, show archives. And we're talking, and we do this every weekend. We talk about financial topics. And generally speaking, most people, when they hear this, they're just they want to make sure they're not paying too much in taxes. They want to make sure that their financial picture is in alignment with what the quality of life they want to look like. It's like, am I saving enough? Am I spending too much? Like, now I'm retired. Like, how should I file for Social Security? How should I view the taxes? How should I view my estate plan?
What account am I supposed to take the money from? And does it matter?
And Alex, you brought up a great story about this. I think this was a couple months ago, which I want to get into. But reality is, you want clarity around your financial picture, and having the right guidance certainly matters. Good financial decisions do not happen by accident. You could also argue the flip side. Bad financial decisions do not happen by accident, right? It's kind of generally like inertia, like a trend that you're into. Yeah. So bottom line is, the right guidance matters. Visit therealmoneypros.com, click on Find an Advisor tab, and we'll help connect you with a fiduciary financial advisor within the Apollon Wealth Management sphere, which is across the country, that will be a good fit for your situation. So again, that is therealmoneypros.com. And again, phone lines are open, 979-59-MONEY. That's 979-596-6639. So Alex, important point about understanding the taxable implications when you think it's just a simple move. And right. I think this definitely falls in the categorization of a retirement tax trap. And that Absolutely. Is where you're pulling money from accounts.
Yeah. Absolutely. Because if it's a non-qualified account, your taxes depend on what transactions happen to fund it, versus if it's coming out of an IRA, it's all taxable. So it also affects, when you take it out, your spendability of the money. So that has to be figured in. You're like, people are like, well, how much do I need? Unfortunately, that answer is depends, because it depends what kind of account it is in. How much are you going to spend? I mean, I can look at anybody's balances and tell you what you can spend. But if you just want a number, I can't give you that. It doesn't work that way, because taxes are such a big part of these calculations.
Well, and you could run into a scenario, and Alex, this is kind of what I was referring to, where if you're not paying attention to that, you could just look at the account balances. Say it's a traditional IRA, for that matter. Let's say you got $1 million in a traditional IRA, and you're like, it's time for car replacements. We've had, me and my spouse, we've had these cars. They got north of 200,000 miles on it. Like, we don't really care about having a fancy car, but like, obviously these things might become a little bit of a liability. Legs. Yeah, we really don't want to be like on the freeway doing like a cross country, maybe not cross country, but maybe going to a different state, or a 6 hour.
Maybe even the next town.
Even the next town. It's like bada bing, bada boom. All of a sudden, it's like you're on the side of the road, the tranny's blown up, or the motor, whatever the case is. So it's like, okay, that's a reasonable thought process to have, of like, okay, well, we got $1 million in our traditional IRA, so let's
spend some money.
Well, we trade in the cars, get a little bit of value for that. Maybe you add in, maybe it's $60,000 all in for 2 car replacements, right? And that's even on the conservative side. Maybe you're buying them used, not even new. So you pull that money out of your traditional IRA, $60,000. Well, guess what happens from a tax standpoint? Wherever you hold your IRA, they're going to kick off what's called a 1099-R. Which is the formal tax document, which tells you, hey, when you file your tax, like, this is what we sent the IRS. They know that you took $60,000 out of your IRA. Yeah. So make sure you include that as income on your tax return. So you're self-preparing, or your CPA or tax professional, they're going to punch out your return. So you're handing them all the tax documentation. So maybe your Social Security income statement, or your tax statement for the year, your pension income statement, your 1099 DIV showing your interest income or dividend income from your other investment accounts. but then you're going to produce that 1099-R that has that
Right.
$60,000 number on it. Well, so when they start adding everything in to the tax return, it's like, okay, here's how much you owe. It's like, whoa, what? Why do I owe that much? Well, the last few years you haven't taken any money out of your IRA, so that hasn't happened. So that Social Security that you were paying no tax on, or maybe 50% tax on, now you're up to 85%. So that affected that. And also, by the way, your Medicare Part B premiums, which are based on your gross income. Yeah, when you fast forward the clock 2 years, you're going to get the IRMAA charge. You're going to be a higher Medicare Part B premium. Meaning,
every month for each of you.
and then let's imagine if you had a capital gains tax where maybe now you're paying more capital gains tax because maybe you sold some stock in your non-qualified account on top of that. Meaning
So you went from a zero capital gains for a small amount to now it's 15% on all of it.
And it's just from the standpoint that you pulled that money out of an account that maybe there should have been a deeper dive into, where what if you could split that up over a year? Like a prime example, I've run into this a number of times where, it's a big goal for retirees that a lot of times to make sure they're debt free. It's an admirable financial goal to have where you're debt free. I mean, hey, the peace of mind that you have that you don't owe anything to anyone in that regard is you could argue it's worth its weight in gold. But when you look at if you have all of your money tied up in a pre-tax account and you want to do some big expenditures like this, like home improvements or cabin remodel or car purchase or whatever the case is, the issue with that is that you run out of room to be tax efficient. So I've done this analysis a number of times where it's like, okay, I understand your goal is to pay off debt and I love it and you don't have it. But if we fund these goals this year entirely from your pre-tax account, here's how far you're gonna be throttled up through the marginal tax brackets. Here's your IRMAA charge. We can no longer do Roth conversions. Your Social Security is now taxed at a high rate. And
now that stock you sold has an extra tax on it.
Net investment net investment income tax.
Yep.
So
just because the IRS decided you make too much money, and they made that number of too much money up.
And there's a point why I'm late, giving these specific line items or bullet points, if you will, which could be the result in doing that. But a lot of times, a good answer to that is like, hey, you're sitting on this incredible amount of equity in your home or maybe your non-qualified brokerage account. Let's use a little bit of leverage, meaning that allows us, we can still pay it off. You'll carry it for maybe 2 years, maybe 3. So you have a little bit of interest charge, but let me show you the actual side-by-side comparison of why we're doing this. And
the little interest you pay is nothing compared to what the tax bill and you're still going to pay tax on that money coming out of the IRA. Absolutely. But let's do it at, 12% instead of 24%.
Understanding the taxation is incredibly important. But the reason why I wanted to label those all out is because not to be like, oh man, just pulling money out, is this confusing? It's like, no, you can see it. There's no longer assumptions or shooting from the hip of okay, well,
I think my taxes will be
and then
much.
You're just waiting. You're just kind of cringing, okay, I'm waiting for that response from my tax professional of how do I owe? Or you're self-preparing and you look at that number up on the left.
That's the worst.
And it just keeps going up. You're like, no, why
and
is there
this many taxes? Red.
And what my suggestion is, do the protocol beforehand. Understand the implications of you have the desired outcome. You definitely have the resources to do it. So have the time, take the time or get the guidance to understand, how do I keep more money in my pocket from a tax standpoint? Because there's so many strategies, and we'll talk about that more. Welcome back to The Real Money Pros. Phone lines are open, 979-59-MONEY. You can also send us a text message. That number again is 979-596-6639. Jeremiah Bates, joined with Alexandra Lundgren. This tax conversation, when we open the show, the line that's in there is it's basically the sentiment is taking these complex, confusing topics and simplifying them. And
we do the best we can with something the government created.
Well,
I'm just saying.
Especially when you look at the tax side of things, it's we got a complicated tax code. Whether you agree with it or not, or you agree it's fair or not, you can give us your opinions on that.
But you kind of have to flow chart it to see where it makes the changes and what affects what.
Well, I geek out on the tax side of things. Interestingly enough, I don't know why, because it's like, it truly is kind of that puzzle solving piece where
Absolutely.
It's like, okay, so here's what we have, here's what we want to do, and there's these different routes to get there. So what if we took this route, that route, this route, or what was a combination of route A, B, and C, and then how does it all work out? And then what gives us the most efficient net number, which again, keeps more money in your pocket. That's really what we're talking about when it comes to taxes. And I'm not a fan of, it's like this term tax loss harvesting, and it's like, oh, I have some losses, so that's great because I can use it to offset taxes. But it's like,
but you still took a loss.
I know. So,
I don't disagree with the idea, and there are times it's really efficient, and it's really something that is something that should be done. But I'd really rather you had money that you paid taxes on than not have money that you don't pay taxes on.
If there's one thing that is a real takeaway for me at this point in my career in observing just human nature, psychology around money, it's if there's friction that gets in the way of one tapping into their accounts, because generally speaking, it's all the good behaviors that you've done through a lifetime to basically have you arrive at a incredibly successful retirement picture, meaning your lifestyle is great. You're funding all the goals that you want. You're still going to leave money left over to your kids, your grandkids. So you're still tapping into that generational wealth. We have the long-term care side of things handled. Like, you just look at that picture, there's really nothing to worry about. But there's still like an underspending of the plan where it's like, no, you could absolutely spend more like that. Those trips that you take, why don't you fly first class?
Well,
right?
And you know why? It's because if they were that person, they wouldn't have gotten there.
Exactly.
It's just the same behaviors that got you there make it more difficult for you to actually enjoy what you've accomplished.
So the reason why I make that point is because the tax side of things is largely looked at as a reason why one won't tap into like maybe selling some stock, like a highly appreciated stock, or tapping into their IRA, or doing the Roth, like those types of items. A prime example is talking to a client, and he owns a position that has done incredibly well. I'm not going to mention it, but it's up. I mean, he's up probably over 2,000%. And I mean, he's got a sizable position in it now. And we were talking a few weeks ago. He's like, what should I do with this? I'm like, well, let's take the like emotion, kind of like our gut feeling off of this, and let me show you the tangible numbers of if you actually made this movement, like what it would look like. Because again, the biggest hesitation was the taxes.
Yeah, let's just look at numbers.
Well, then when we really dove into it, because he's like, well, then we can't do Roth conversions. I'm like, what is going to have the biggest impact of quality of your life, like actual economic impact for you and your spouse? And he's like, well, yeah, selling the stock. I'm like, also, do you feel emotionally tied to this? Like, meaning if the stock's up and the stock's down, like you're watching every day and it's just kind of putting you through this whipsaw. He's like, well, yeah, that's the biggest thing why I want to sell it, because it's like, it's just so high. We have such a high degree of our wealth in this stock. So he's like, I feel a little overconcentrated, and if this thing could easily drop 50% based on the growth that it's had over the past couple of years. So yeah, I just don't want that to happen. So I said, those are the two answers that we're going to hold in highest regard. We're not going to let taxes, the taxes will influence our decision, but it's not going to be the primary focus. So now that we know the game plan, now let's talk about how we execute it and making sure that we understand the tax obligations so there's no surprises. So when we really dove into it, he's like, but then it's going to be taxed on income. No, it's taxed at long-term capital gains rate. So what this means is that, and I was explaining this to him, like, let's look at gross income, how it affects gross income. Let's talk about the actual taxes that will be owed on the sell. Let's look at the net investment income tax, and then let's look at the ordinary income tax. That's really the three buckets of taxation that we're looking at. And for them, they're not on Medicare yet. They're early retirees, so we don't necessarily have to worry about. There's nothing from a gross income standpoint that would cause a direct effect of higher costs of like just standard lifestyle, because they're not getting a tax credit for their health care. So we don't need to worry about that. They're not on Medicare. They're not receiving Social Security. So the receiving more gross income isn't going to necessarily move the needle. So they have some rental properties. They've sold some rental properties where they're carrying the note. So that will be subject to ordinary income taxes, which is pretty low. So, I mean, their effective ordinary income tax rate, I think it would still be around 10%. So I said, yeah, that number might look high from the capital gains that we're recognizing, but You're married filing jointly, which means your taxable income can be all the way up to close to $600,000. And all of those capital gains will be taxed at ordinary income tax rates. He's like, but the net investment income tax. I'm like, well, that's a whole different formula, and I don't want that to dissuade you, but let's calculate that. And that was only going to be, I don't know, like a few $1,000.
Yeah,
like,
it's not a huge percentage.
So when we looked at it, it's like, so now he moved forward. He sold the stock. And now, by the way, we're going to do a donor-advised contribution with some highly appreciated stock as well. So that'll help lower the tax bogey too. So it's a long
and
story.
Can be carried forward if there's too much of it.
So if you look at that protocol that we identified it, we looked at what the desired outcome was, we looked at all the resources, then we analyzed the numbers from a tax standpoint and everything else to arrive at this is the best plan that covers tax efficiencies, economic impact, and the emotional side too, like the psychology side.
Right.
And he's like, gee, this is great.
Sometimes it just needs to be just the numbers.
Yeah.
I had a gal come in who had just a regular stock account. She had some shares in there. They'd been there since her divorce a long time. It was something she got, and she literally had ignored this account. And she thought there was like $2,000 or something in it. Well, over time, because of what some of the holdings were, when she went to look at this as she's retiring this fall, it's worth closer to $100,000 now. I mean, it's been a while, but it's of a significant value. And she came in and she's like, I have a tax problem. I'm going to have a $20,000 tax bill. And I said, yes. And you're going to have an $80,000 windfall you didn't expect. And she's like, oh yeah, that's okay. It's just how you look at it, right? I mean, does she want to hand over $20,000 of this in taxes? No. But she's got a lot more than she thought she had before she opened up the account.
Yeah. So all that ultimately arrive at when it comes to the tax side of things, I'm a huge fan of being tax efficient, but the way to be tax efficient is to dive into it. And one thing I want to add into this too, by the way, and this is and not to upset any tax professionals out there, but this has just been my own anecdotal experience really over this past year where I'm a huge fan of coordinating with client tax professionals because it makes it better. And I'm not afraid to ask dumb tax questions, but I'm a huge fan. I mean, I know enough in taxes to be dangerous. Like I'm not completely inept, but yeah, we'll come up with some ideas. And I've been surprised at the response from a few tax professionals to where it's like, no, like the savings really aren't there. Or it's just some kind of vague response as to why it probably shouldn't be, there shouldn't be a deeper dive into it or to really explore it. I would be extremely careful with that, where it's like, okay, well, if that is your response, like even if the tax idea is not coming up from your advisor, like maybe you read an article online or you saw something or you're hearing something in our program and you present that to the CPA and their response is just kind of like, like a
vague blow off.
And it's not even a deep dive, like not even a dive. Like
here's the numbers.
They didn't even put their toes in the water. They're just saying, like a 1 cent response. And you're just thinking, okay, it's like, I would be extremely leery of that. I would want to know the why behind it. Like actually show me the numbers that you are seeing that's letting you arrive at this simplified response. And
yeah. And if it's just because my tax bill will go up this year, but maybe it's less the next 5 years, let me decide.
Yeah.
And maybe I don't want to. That's fine. But I mean, I like more information than that. That's kind of why I do what I do.
Well, it's
your bill. You should too.
If you're paying the professional, generally you're paying them because you like that they have experience or they're professionals in this regard. So then if you're paying them, it's like, yeah, I want your expertise as to why you're saying this is a good idea or a bad idea. So just wanted to throw that little caveat in there from a tax standpoint. But again, when you're retired, understanding how these income retirement sources interact are extremely important. You got the traditional IRA or 401k withdrawals. Maybe you have the pension. Maybe you have Social Security, capital gains. Let's not forget about Roth distributions, taking money out of your Roth.
Inheritance, gifts.
Inheritance, or if you receive inherited IRA, and how the withdrawal sequencing of these are extremely important because taxes aren't created by one account. They're created by how your income sources work together. So again, visit therealmoneypros.com. We're going to talk about all this when we come back from our break. Again, phone lines are open 979-59-MONEY. You can also text us 979-596-6639. You have tax questions, or you want to deeper dive into some decisions that you made that gave a tax surprise, or you want to get ahead of the not necessarily tax filing or tax strategies now, give us a call. We'll be right back. Welcome back to The Real Money Pros. Again, phone lines are open. We are live. Last segment of the first hour, but you can catch us for hour number 2 or hour number 3. You can visit therealmoneypros.com. You can catch any of our previously archived episodes, our podcasts. You can sign up for our newsletter. You can see who our sponsors are. Listen, we're not here to sell you anything. We're here to educate and talk through any complex issues that you may have. So give us a call, 979-59-MONEY. Send us a text message, 979-596-6639. You can also send us emails. You can send it to Jeremiah at therealmoneypros.com, Alex, ALEX, at therealmoneypros.com, and we will get you a response. So we have some text messages, some text questions coming through the text line. So I kind of want to dive into these because these will kind of hit on some of these items that I wanted to hit on. I'll try to summarize this. My wife and I are thinking about taking a big IRA withdrawal this year to remodel our house. It's our first full year of retirement. We want to make the house the way we want it. I totally agree with that. Sounds like it's not as simple as just paying more income tax. We're 66 and 67.
Yeah, it's not as simple. Now, the fact they said first full year of retirement clues me into the thing that we don't have W-2 wages probably from a paycheck for a partial year, which sometimes gives you a higher income that you're dealing with these than you will in a full year of retirement. So sometimes that's the first suggestion is like, let's wait till next year to pull them. 66 and 67 may be taking Social Security, may not.
Yep.
They're on Medicare, so we just need to stay under certain brackets so that we don't bump up their IRMAA. So it's one of those where we look at, it's back to what you were saying earlier. Can we do some of it this year and some of it next year and still have you accomplish what you want to, maybe with a HELOC or some money in a non-qualified rather than an IRA account, because you don't want to drain all of that, but you do want some. So, but there's still, for a lot of people, there's still a lot of room in that first IRMAA bracket. It's like, is it like 216,000 or something?
218. So
218, yeah.
So to be clear about IRMAA, so this is regarding your Part B Medicare premium. So your Part B Medicare premium is based on what your annual gross income was 2 years prior. So meaning for your 2026 Medicare Part B premium, that's going to be based on your income from 2024. Now we've talked about there's a form. I mean, you can basically have how the IRS reevaluate your income to make sure.
And if you retire, you absolutely should if your income's going to be less than it was while you were working.
Exactly. So
I mean, don't wait 2 years.
So in this question, I mean, we'll make some rough assumptions here because we're missing some context on a few things. But like the biggest things to pay attention to, right? Where if you're going to do a significant IRA withdrawal, I mean, when I hear the term significant, I'm thinking around 100,000.
I'm thinking that or more.
Yeah.
In my brain, when you say significant, now they could mean 20,000. We don't know, but I'm going to assume 100,000 or more.
So there's a few things that you need to pay attention to. One of which is if you do a significant IRA withdrawal this year, what are your other income sources and combine those together? Like what is your projected gross income going to be, assuming you do that IRA withdrawal this year? I would say that'd be step number one. And then there's two things that are likely going to be impacted by that. So obviously your Medicare IRMAA charge. Let's see where you're going to fall in regards to that. And are you only going up one bracket? Because for 2026, just to give you an idea, if you're filing a joint tax return, your gross income is $218,000 or less, you pay around $203 a month for your Part B premium. If you're above 218 but below 274,000, your premium jumps up to 284. So there's about an 82 difference between there. But the next one
times 12 times 2.
Yeah, the next bracket goes up to 405. Like that's a pretty dramatic jump going from, not as big of a jump going from 202 to 284 per month. Jumping from 284 to 405, that's a pretty big jump. So
yeah, the other one with a 2-person household is about $2,000 a year.
So again, we want to weigh those. So gross income, look at how would that potentially impact the Medicare Part B premiums. And again, take that with a grain of salt, because I mean, if this is an unusual, like one-time high income year, then it's like, okay, well, if we're looking 2 years prior, that means that would affect your Medicare Part B premiums for 2028, and maybe it's just 1 year. Maybe. I mean,
well, and then the other thing to keep in mind is that we have this 4-year window where they're over 65, where with a 2-person household, we get an extra $12,000 of standard deduction.
There you go.
So that's an extra $12,000 potentially that doesn't have the income.
So you bring up a really good point on that, right? So we're looking at what could that income potentially affect. Obviously, that's going to affect your marginal tax brackets. Also could affect your state income tax wherever you reside. It could potentially affect your Medicare Part B premiums, and also the taxation of your Social Security, right? So let's pay attention to that. And then, Alex, you bring up a really good point. And we're going to talk about this the next hour around Social Security, because there's a big myth right now that Social Security is not taxable. That's not the case. What did in fact happen is now seniors, 65 or older, you get what's called an enhanced senior deduction.
Yep.
So for a married couple, that could be up to $12,000, because $6,000 per person. Now that is based on your gross income.
Right.
If you make more than $150,000 married filing jointly,
it phases out.
It slowly starts to phase out. So those are the things that I would look at. So now let's imagine you do that protocol, whether you're doing it or you have your tax professional or your advisor look at all this, and then you see that number. Then we want to say, okay, is there different routes we can take to then, because now we're talking about you have the money, you've saved enough, you can do the remodel, but now let's make sure we don't have to, we can keep more in our pockets. So maybe that does look like splitting up those IRA withdrawals instead of all in 1 year, like in 2026. Maybe you do half of it in 2026, the next half January 1st, 2027. Most remodels, you're kind of paying as they go.
Yeah.
I mean, the contractors...
Makes it a little hard to split it like that.
There's one piece of advice: never prepay the contract. Pay them, they might have some criteria, but never pay 100% of that work that needs to be done before it's done. I have some clients that have some horror stories, meaning you're usually going to have some held back at the end of the day. When the work is complete, then you can make good on what you actually owe them. So, I mean,
maybe if this is like a house and a landscape thing, maybe do the house this year, landscape next year, or whatever. I mean, who knows? Yeah,
or maybe you split it up over 3 years. Or if it's something that has a tremendous amount of urgency on it that you want to get done, maybe you look at tapping into some of the equity that's in your home. Maybe it's through a home equity line of credit, and then you're gonna those people who are afraid of debt, or they said, no, I don't want any debt. No debt, bad. No, it's well, look at the finance cost. I mean, look at the finance cost compared to the taxes that you would pay. And a lot of times there's a big gap between those. So honestly, the interest cost that you would carry maybe a year, maybe 2 years, maybe 3 years is going to be negligible compared to the tax savings that you would have. So
just do the numbers. The numbers give you an answer.
So to answer this question directly, where they said it sounds like it's not as simple as just paying more income tax, you are absolutely right. It is not as simple as paying more income tax. There's a lot more things that could be affected. I mean, those waves will lap across all these shores. So just follow that protocol. Just get an idea. And then also on top of that, once you get that whole plan set, then you could look at, okay, how do I look at paying taxes this year? Should you start making some estimated tax payments? How much withholding, or if any withholding, you should do out of your IRA distribution? So there's a lot of things that branch off from that. But bottom line is, yes, remodel the house. You're going to live in that probably. It's probably the last house you're going to live in. So get it the way you want. It's full year retirement. It's where you're going to be spending a majority of your time. So yes, get the remodel done. But just look at the numbers. Make sure you're cognizant of the tax picture here. Again, phone lines are open 979-59-MONEY. That's 979-596-6639. We got another text message coming through. I want to go back to work part-time. I'm needing something to get me out of the house. So that's not too uncommon for people who are retired. I'm 64 and I just have Social Security and small IRA withdrawals as needed. So working will reduce my Social Security benefits? ? The extra cash would be nice. I'm not looking to reduce my income at this stage. Okay, there's some parts of this, and we are about a minute out from a hard break. So, Alex, let's carry that question into hour number 2, because
maybe
there's some misconceptions around this where if you have filed for Social Security and then you go back and enter into the workforce, maybe that's through a W-2 or through self-employment, there's a misconception that, well, if I make money on top of my Social Security, then they're going to reduce my Social Security, and I don't want to have my Social Security reduced. Sometimes.
And sometimes not.
Sometimes not. And at the end of the day, you're not losing that money.
Absolutely.
It's just kind of delayed because now you're earning more income. So again, this is The Real Money Pros. Visit therealmoneypros.com. We got a break. We'll be back for the next hour. Stay with us. Confusing money topics made simple. That's what we're here to do. We are fiduciary financial advisors. We are The Real Money Pros. This is hour number 2 of our 3-hour live program. Live meaning you can interact with us. You can call us, you can text us, you can email us, and we will get you an answer on the air if you allow us. So give us a call, 979-59-MONEY. That is 979-596-6639. You can text that number, send us an email, Jeremiah at therealmoneypros.com, Alex at therealmoneypros.com. And the first hour we were talking about, hey, when you're retired, the taxable headwinds that arrive with retirement, and you look at all the various sources of incomes and how withdrawals out of certain accounts can really make or break how much money that you're keeping in your pocket. And you could also argue that same consideration with how you view your filing of Social Security, meaning Social Security strategies. And before... And hey, if you want to call the program and give your commentary on what you feel about the state of Social Security and how it's the Social Security fund is going to run out by what? What's the latest number? Like 2035 or 2032?
Yeah,
something along those lines. You got to take it with a bit of a grain of salt. I mean, listen, there's a lot of risks that we are up against when it comes to your financial picture, and a lot of it's legislative changes, right?
Absolutely.
Like we know what the tax code is right now, so we couldn't have speculation on where taxes are going to be in the future, but we got to make our decisions based on what we know is right in front of us, and also be prepared. Hey, if there is a change, okay, then here's how we can potentially prepare it. And you could also look that through the lens if you had a disability event or if you have a long-term care event. It's like we're not anticipating these changes or these curveballs, but it's not a bad practice to say, well, if that were to happen, let's just go through this practice of if it were to happen, what would it look like? How would it affect things? So if in the event that curveball did come across your home plate and you got to try and swing and hit that thing for a base hit, it's like you can change your stance. I mean, you're not caught left on your heels and missing it completely. So from the Social Security standpoint, yeah, I think you should plan for it to be there. Now, In my case, I got many years from retirement. Maybe I'm not necessarily leaning on that, but hey, at the end of the day, I'm still paying into Social Security, so I do have some level of expectation that I will receive some level of income when I'm in retirement, and hopefully that money doesn't go to nothing because it should go to my benefit. But for those of you who are approaching retirement and they're looking at, hey, what is the best Social Security filing strategy that's in front of us? This is an important thing to talk about because when you look at the dollar amount, what that represents from a cash flow standpoint, I think it catches a lot of people off guard of like,
right.
Especially when I'm doing planning with clients and we're going through like that projected cash flow sheet, and you also look at the cost of living adjustments that's within Social Security, they're extremely surprised of, wow, that's gonna translate into that much income when I actually file for Social Security and my spouse files for Social Security. I'm like, yeah, that's exactly what it is. So it should not be slept on. And with Social Security, it's not a one size fits all. There's a lot of the answer that everyone loves is, well, it depends. It certainly does depend on your age. It depends on, are you married? Are you single? Like, how do you treat the household finances when it comes to these types of things? So, Alex, I would argue you are our in-office resident Social Security expert, and let's just put it out. I mean, where are you arriving at with? What's the base case with Social Security? Like, let's imagine you're 60 years old, and you're like, hey, I want to retire in 2 years. How should I be viewing Social Security? Let's just make this easy.
Yeah.
Both spouses are age 60. They're both working. They've both paid into Social Security. It's like, what would your initial guidance be of, well, here's what you got to do, and here's how we got to arrive at doing that. And we can make up some hypothetical numbers on how you would look at it.
Well, I think the biggest thing is don't discount that you are going to have Social Security, because it is there and it is a part of a whole network of payment systems, not the least of which is Medicare is part of this same batch of things. Disability is part of it. That even if they have to reduce benefits, the total disappearance of this, it would be catastrophic in this country, honestly, because there's such a large percentage of Social Security is pretty much what they live on, these households. But I think the questions that come up are, do you have health issues or not? Are you expecting longevity? Are you expecting to not live very long? What is the financial picture look like outside of the Social Security benefits? Is it something where we're going to need to make sure whichever spouse lives longest is getting as much as possible from a source that we know won't run out, as far as like the account's empty and there's no more payments? Are you going to keep working? Are you going to stop working? What's your other sources of income? Because sometimes we want to delay Social Security, but we like that same amount of income, so we create a bridge from other sources. Some people say, I want to take it early and save it. Well, let's just let it grow what we know it will grow if you don't take it, because I can't guarantee those kind of rates of return outside of it. Because that increase in payment is an even larger increase in what the account itself needs to do to fund it. Just all different kinds of things that way that come into this. What I can tell you is almost never the answer is, what did your neighbor do?
Yeah.
People come in and they've heard this and they've heard that and they've heard the other. It's what somebody else did or should have done may or may not apply to your situation at all. Like, not even close.
Like, is it safe to say that one of the biggest questions is, should I file early? Should I file at full retirement age? And should I delay? And what does that even mean?
Yeah. So if you can file for Social Security as early as age 62, unless you are receiving a spousal benefit from a deceased spouse, and then that's as early as 60. But 62 is the earliest. They do have earnings restrictions on that up until you hit 67. There's a few people that are still in the 66 in so many months, but 67, which is full retirement age now.
So earnings restrictions, real quick, let's cover that. So that basically means that if, let's say you filed for Social Security at age 62.
Okay.
So obviously you're receiving a reduced benefit, and we'll get into actually what that reduction is. So obviously you're receiving a reduced benefit, but you still continue to work, meaning you have earned income. That's the key word there, earned income.
IRA withdrawals do not count.
Rental income, income from rental properties don't count. Pension income doesn't.
Most pension incomes don't count. There are occasionally pensions that do, and they're unique, and most people who are in them are aware of that. Not always, but usually.
So that reduction essentially is Social Security saying, hey, if you make a certain dollar amount of earned income in a year, and there's a threshold to that, then you could be seeing a reduction in your Social Security benefit just until you hit age 67.
Right. So what happens is it is meant to be for people who no longer have income. And so if you're still working, they really don't want you to start taking it. That's the whole purpose of this. Every year, the amount that you can earn goes up just a little bit. Hang on, I got to check as it goes up. It's $24,480 right now.
So meaning if your earned income through self-employment or W-2 is below $24,000 for 2026,
they won't do a reduction next year.
But as soon as you go above that, then you could be looking at a reduction.
Yes, and so at high level, basically for every $2 or over that you earn, they reduce your benefit by $1. for the next year. And they do this year over year until you hit age 67. And then at age 67, they will re-amortize your balance and throw in whatever they didn't pay you to that. And it might increase your monthly check by like $1 over the rest of your life or $2 over the rest of your life. But you do get it back.
Okay.
So you didn't lose it forever, but they're saying, hey, you're telling us you didn't actually need it.
So now if we go back to, 67,
is you can earn as much as you want.
So, but full retirement age, that's generally like the number. So that full retirement age of age 67, that is what the IRS looks at as like the
pivot point for everything.
The pivot point of basically saying, well, if you delay till age 70, then 66.
Now we're going to add to it.
We would add to it. And then if you take it early, you're seeing a reduction based on what that amount would be
at
that you
67.
Would see at 67. So that's where you can really dive into, okay, what do things look like if I actually file early or if I file later? And is that the right decision to make? And I appreciate you saying that, Alex, where, there is this thought process that comes in the equation. Well, no, I want to get it as soon as possible so I can get that money and I can invest it because I've been crushing it with my investments in the technology space over the past few years. You might want to hesitate against that because you might be having some lofty expectations on that. We got to take a break. Stay with us. We are back. This is The Real Money Pros. We are live here to talk about any topic that you want guidance on or you have questions on when it comes to your financial picture. You want to talk about estate planning. You want to talk about taxes. You want to talk about the rough go that we've seen in the markets really over maybe the last week and a half. And I hesitantly say markets because really where we've seen just a little bit of a pullback in these high-flying semiconductors, chips, the AI narrative. It seems like we're seeing a little bit of a pivot. We're seeing oil prices continue to gain as that conflict with Iran continues to escalate to an extent. But if you want to talk about markets, you want to talk about how that could potentially affect your retirement picture, you want to talk about investing, SpaceX now below that IPO price, finished Friday down 5%. A lot of moving parts going on, but right now we're talking about Social Security strategies, but if you want to change the topic, fair game, call us 979-59-MONEY. You can also send us a text message. That is 979-596-6639. I want to get to the text line because we got a good question. I'm wanting to go back to work just part-time as I need to get out of the house. I'm 64. I'm receiving Social Security. I take some small withdrawals out of my IRA. So will working reduce my Social Security benefits? The extra cash would be nice, but I'm not looking to reduce my income at this stage. So that kind of goes in line, Alex, exactly what you said before we went to the break of what the reduction actually looks like when you're receiving Social Security and then you add wages on top of it. So bottom line is if you want to go out because you want to fill in some time. Maybe you want to work part-time at Lowe's, Home Depot, whatever the case is, and you feel good about your cash flow, but you just inevitably through what you want to do with your time, you're going to get some income for 2026. As long as that gross income is below
basically $24,000,
is below $24,000, you will not see a reduction in your income at this stage, meaning reduction from your Social Security income. Now, if you go over that amount, yeah, you probably will. You'll see a reduction in your Social Security income, and how much really depends on how much income you earn above that $24,000, number one. And then secondly is when you hit age 67, there's no reduction anymore. And if you did have a reduction starting at age 64, and then you had it at 65 and 66, then you get basically a re-amortization. So that reduction you don't lose. It's just basically added back into your Social Security benefit when you're actually at 67, which is full retirement age.
Yeah. And the other thing to be aware of is that when they reduce your benefit, you don't get a letter that says, hey, instead of $1,200 a month next year, you're going to get $1,182 a month every month next year. You'll get a letter that says, hey, you're not going to get your February check and your March check is going to only be $503. They just hold it up front.
So how does
because if you die, they can't get it back.
Yeah, that's a good point. Now, is it done meaning? So let's imagine, he filed for Social Security. So he's been receiving a Social Security benefit. Let's just imagine it started January 1, 2026. And obviously when he applied, going through those questions, he probably said, no, I don't plan on working. So he's getting that full projected benefit, right? So no surprises. And then let's say he starts working halfway through 2026. I would assume that that activity that he received in 2026, assuming he goes over the amount of reduction, that would take place in 2027.
It will as soon as the report gets to Social Security that shows how much you earned. So the same records that track what you earned and you put in over the years, it's not necessarily your tax filing. That comes from your employers and gets reported. So as that gets updated and in there, that's what they'll utilize. So, and it can be delayed. I mean, it's not like they're going to have it January 1, but you will get a letter and there you go.
So there you go. There's your question. So to answer it directly, will working reduce my Social Security benefit? Answer everyone loves.
It depends.
It depends on the amount of money you earn, but we also went into those specifics. So
the other thing I want to make sure everybody is clear on is we use that term retirement a lot. Retirement and when you start Social Security benefits are not necessarily the same thing. You can retire at age 64 and not turn on your benefit until age 68. You can turn on your benefit at 67 and not retire until 70. Whatever it is, they're not aligned necessarily. Sometimes they are, and sometimes they're not, but they aren't dependent on each other.
Well, a prime example of this, we met with a prospective client earlier this week, and we're doing the whole retirement plan, cash flow plan. It's like he works, he likes his job, but he's like, hey, my whole plan, and I mean, that he's followed to a T. He's like, my whole plan has been just work until I'm basically 70, and he turned 70 January of 2027. He's like, no, that's the plan. I was going to work until basically the end of 2026, makes good income. I'm going to maximize my Social Security benefit. That'll pay in. Actually, there was a takeaway from that meeting. I meant to ask you on Friday, but I think I'd had other appointments, and by the time I came back in mind, I think you were out of the office. But he brought this up. So he's like, well, I just got a raise. So in 2026, I mean, basically halfway through the year, we're over halfway through the year. So basically the last 6 months, he'll get a raise. I don't think it's huge, but maybe let's just say it's another $10,000, right? And he's like, will that make a big difference on my Social Security? And he's like, and then maybe if I worked a few months going into 2027, would that also increase my Social Security benefit? And from what I understand, I was like, yeah, I mean, possibly, but
not a large amount.
That's all I was like, I think,
because it is your 35 highest earning years. So if this 26 becomes one of your 35 highest earning years, they will use that for the calculation, but it's an average, and then it's turned into an income level. It's fun math. It's calculator math.
But meaning six months of increase, like meaning 1 year, and even if it's, it doesn't sound like it's a substantial raise.
It won't. It will affect it.
It'll affect it, but it might be negligible. Like meaning it's not going to be like a make or break of like, well, I should delay my retirement because I'll increase. Meaning it's just not. It's not going to move the needle enough as far as increased retirement.
It's going to be probably anywhere from $1 to $12 a month, maybe. Okay. And 12 is a big leap. It depends. That's only if some of the early years were really bad.
But you bring up a good point around this. It's important to understand these concepts, if you will, where retirement doesn't necessarily mean Social Security. Like I got plenty of clients that retire early to mid 50s. It's like we know that Social Security isn't going to be considered for another 10 to 12 years at the soonest, right? And obviously we put that in the forecast, which also helps us arrive at a good distribution plan pre-Social Security, because it's like, well, arguably the money that you're withdrawing out of assets over the next 10 years, that isn't necessarily sustainable all the way up to age 95. But hey, guess what? We turn on that Social Security spigot, then it completely game changes because you're not taking that same level of withdrawal.
And that's the part that has to happen, that sometimes they forget to tell us. Or you just kind of like the extra. That is one of the big cautions I will tell people is, even if you hit age 67 so they don't care how much you earn, please don't start while you're still working. It becomes part of your required income.
Interesting. There's a lot of moving parts with Social Security. Obviously, there's some relative, like when there's less moving parts, there's a little less sophistication that goes into the decision making when it comes to filing for Social Security. Now, let's get into the ones where it gets kind of fun, where you kind of really get to do some puzzle piecing, because where I would argue that there's a tremendous opportunity to look at various filing strategies is when you're married and you you have one spouse that may have a higher one and one spouse has a lower one, a difference in ages, lots of stuff to think about, not only from cash flow. Does one file early? Does one delay? Do you both file at full retirement age? How does this affect the surviving spouse via the widow benefit? How does this affect taxes? You got options. Let's make sure we explore the right ones. This is The Real Money Pros. We'll be right back. Welcome back. We are live. Phone lines are open. Give us a call, 979-59-MONEY. Send us a text message, 979-596-6639. This is The Real Money Pros. Visit therealmoneypros.com. You can sign up for our newsletter. You can get access to our sponsors. You can get our podcasts, our previous archive show content, our YouTube videos, basically our library of educational content that covers topics from estate planning to concentrated stock positions to tax efficiencies to sequencing of withdrawals, ultimately ideas that you can hopefully put into practice, or at least maybe put a question in front of you that you may not have otherwise thought about. And it's funny, anytime I meet someone new, and I'm definitely at that season of life with my daughter, she'll be in second grade in a few months. So obviously she's getting involved in more, activities. We're, more involved with things that are going on at school. So you meet other parents and you just get connected to other people. And inevitably the question comes up, oh, what do you do? And my response is, well, I don't know, 70 to 80% of the time I'm a wealth manager, fiduciary financial advisor, and then the other 20 to 30% of the time I am a financial radio show host, right? And
I just say 40% of the time I'm a counselor and 60% of the time I'm a teacher.
There you go. There's a lot of half a dozen one way, six the other, right? But it's funny because when I say that, it obviously it's true, but I really think when I think about this, it's how well these two things complement each other. And, obviously we have our standard practice during the week, Alex, Monday through Friday, where we're rocking and rolling. And then, which
is so fun.
And obviously there's radio components that are involved in that during the week. And then on Saturdays, we're rocking and rolling for probably an entirety of 4 hours, doing all the stuff with the radio show, because we got the 3 hours live broadcast, and then we got generally, we got time to prep, and I'm usually up in the morning prep. I mean, you get the whole picture, but the reason why they complement each other so well is because we can take topical news, we got to be on top of obviously what's happening, and we can take these complex or maybe dry or boring financial topics and make them more interesting. And then also the real life interactions that we have with real people who are navigating life, trying to do the right thing, trying to figure this whole thing out. It's like we can take those same scenarios, and obviously we're going to be cognizant of personal information. We're not going to share that on the radio.
Right.
But we can take those real life experiences and apply them to hey, here's this topic that we're covering. And we'll talk about it at high level, but then we can say, here's how this has actually been executed in these various situations that are real, by the way.
Yeah.
So the whole idea of saying that is, that's when you call in, change the topic. We can talk about estate planning. We can talk about RMDs. We can talk about Roth conversions. We can talk about IRMAA charges, net investment income tax, or some hot topics that you may have seen online that you might need to dive a little bit deeper into. So give us a call, 979-59-MONEY. Send us a text message, 979-596-6639. Social Security. Now let's get into strategies, because if there's one thing that I've certainly noticed is where the opportunity with how you really ring this Social Security chamois, it opens up when you are married. Meaning,
for sure.
You have a Social Security benefit and your spouse has a Social Security benefit. And also, by the way, I actually ran into this a couple weeks ago where
your child may have a benefit.
But the spouse, meaning she was a state employee, so she was not paying into Social Security. So she was like, no, I don't have a Social Security benefit.
Oh, because they pulled back all the windfall and the spousal
So, there was not any dollar amount that she paid into it. So her expectation was like, no, I'm not going to have any. And then my husband will have Social Security. Well, it's actually...
She gets a spousal.
Well, it was funny because we were kind of looking at the projected cash flow, looking at the whole plan. She's like, well, why is there a Social Security benefit showing for me? I'm like, oh, you get the spousal benefit. I get the spousal what? And she's like, no, I don't get it. I was like, well, let's dive a little bit deeper. And yes, you actually do get a Social Security benefit.
That law
it's not your, when we're really talking about the nuance, it's not yours. It's deemed as the spousal benefit. So I digress. Alex, when you're looking at spouses and the opportunities that are available, what are things that people should consider before they just go to the Social Security office or jump online and file?
I think the overall financial picture, if only one of them were living, should be considered, because that whichever of the checks is the highest is the one that continues. But costs don't go in half. I mean, that is one of the things in fact, costs really don't go down at all, because you have the same housing expense. You have the same to heat or cool your house. You still eat. You still do things. The costs don't reduce much between a 1 and a 2 person household. So if this is your entire income, is your Social Security, and one check disappears, that's really all you're left with. And so it's really important to know that whoever lives the longest, there is enough for them. And sometimes it may be only an extra, $60 a month, and you're like, that's nothing. That's not going to count for anything. Why would I wait for that for the spouse? Well, if their check disappears, the smaller check disappears, and this one's $60 a month more, that helps. Plus, all the cost of living for the rest of the time gets applied to an extra $60 each time, month time. So it over time can be a substantial difference in the dollar amount.
And then specifically including the Social Security terminology of what you're talking about. And these are two terms that I think get mixed up a bit. You have the spousal benefit, and then you have what's called the widow's benefit. And
right,
Alex,
survivor benefit.
Yeah. So Alex, what you're referring to is, okay, if Social Security is making up the majority, if not all, of your retirement income, meaning for the two spouses, and obviously we know, and what we're talking about is potentially delaying, meaning, what if one spouse were to delay their Social Security filing to, let's say, maybe age 70 to maximize the benefit that you have? And one of the considerations that you could take in doing that is, well, let's look at health, even though we don't have a crystal ball, but that's something that could be taken into consideration. But bottom line is, if the higher receiving Social Security spouse passes away, then the lower receiving Social Security spouse gets the higher of the two benefits.
Correct. So let's say there's a $800 check and the other one delays until 70 and it's $1,200. That's $2,000 a month coming in, right? The 800 might be like, you know what? If I take it a couple years earlier, it's only 700, and that's okay. Well, fine, because that's the one that goes away. But if the 1,200 is the one you get to keep, and you take that one earlier, and now it's only 900 and 800, and the 800 goes away, that's a much larger percentage of the total income you've lost, and those expenses did not go down by that.
Indeed. Now, that's something to take into consideration for the delaying, but also as well understanding that there is the potential benefit, like there's a lower income earning spouse. So, for example, this is a situation that happened a number of years ago where we were analyzing Social Security, and the higher income earning spouse, meaning the one that paid more into Social Security, rock and rolling with work. I mean, had no desire to retire early, liked the job, was getting significant income increases along the way.
Yeah.
So he's like, no, let's keep going. So in doing that, delayed his Social Security filing just because he had no intention to leave the work. He was working by choice, which is kind of completely changes your mindset on how you approach work, in my opinion.
Yeah, a little bit.
But we arrived at that. And then we looked at the spousal benefit, or sorry, the lower income earning spouse, Social Security, her benefit, not the spousal benefit, just her benefit. It's like, yeah, let's turn it on. She actually turned it on at 62. It wasn't very much, but it was like, yeah, we can get an injection of discretionary income that the spouse certainly would appreciate.
Yeah.
And it wasn't going to move the needle entirely. It wasn't going to cause any tax implications. Oh, and then, by the way, when the husband hits full retirement age, it's like, yeah, then we can turn on the spousal benefit. Meaning, and this is something that I want to get into, Alex, when we look at the behind the scenes, like how we arrive at actually what the spousal benefit is. And maybe that's a good place to start. What is the spousal benefit? So
the spousal benefit is basically, Social Security has said, if you look at what the full retirement age, which is now 67, calculation is of each party's benefit, and let's say one is a much higher earner and at 67, their benefit's going to be $3,000, and the other spouse has, stayed home with the kids. They worked when they were little, work some more now, but their time of money put into Social Security wasn't nearly as much, and so their benefit at 67 is going to be $500. That's their benefit. That's the one that if they continue working, that we're calculating on, they could take early at 62, whatever the situation is. However, Social Security says that as a spouse, you will be entitled at full retirement age to a minimum of half the value of what your spouse's full retirement age benefit is.
So let's just do that scenario. So let's imagine it's you and me, right? Let's just use it easy, okay? Alex, your Social Security benefit, assuming you take it at 67, which is full retirement age, $1,500 a month. Assuming I take my Social Security at full retirement age, $500 a month. So there's a $1,000 difference. So under the assumption is this. If you file at full retirement age and then I file at full retirement age, I will get an amount that's half of yours.
$1,500.
So
$750.
Okay. Yep. So $750. I think but the original number used $3,000.
That's
right?
okay.
All right. We'll refine these numbers when we come back. Welcome back to The Real Money Pros. Again, good financial decisions do not happen by accident. Whether you're navigating retirement, trying to save on taxes, making prudent business decisions, particularly around exit planning, or maybe you want to offer some shares to employees, or how do you get some equity out of your business, or you're just looking for clarity around your financial future. Having the right guidance matters. And if there's one thing we're trying to do here at The Real Money Pros, we're here to guide, not sell. Sponsor-driven program. At the end of the day, there is no product that we are here. We are fiduciary advisors on the program in our real-life practice. So again, if you want to get connected with a fiduciary advisor who can help you, visit therealmoneypros.com. Click on Find an Advisor tab. We have a network of awesome fiduciary advisors across the country with Apollon Wealth Management who we can help you get set up with, and we'll arrive at the consideration of who's a good fit for your situation. And that, in fact, might be me, Alex, someone on our team, or maybe it's someone in Florida. Maybe it's someone in Pennsylvania. Maybe it's someone in Chicago. I mean, if you name it, if you have access to this program, there's going to be someone in close proximity as far as fiduciary advisor that you can meet with face to face. But you got to love technology with Zoom and the ability to connect with people. I mean, I love the face to face, and I try to get in front of clients as much as I can. But there's also something to be said about those efficiencies. But at the end of the day, visit therealmoneypros.com. Click Find an Advisor. If you have direct questions, you can email myself or Alex. It's Jeremiah at therealmoneypros.com, Alex at therealmoneypros.com. And again, we're a live program. So if you want to change the topic, you want to talk about Social Security filing strategies, that's what we're covering right now. Call us 979-59-MONEY. That's 979-596-6639. You can send a text message as well. Okay, Alex, let's go back to that scenario.
Okay.
With the opportunity of filing Social Security strategies when you are married. Because again, you have the spousal benefit. So the spousal benefit essentially says that, hey, we are going to assume that both spouses are going to file at age 67, which is what Social Security deems as your full retirement age.
Yeah, it's the pivot number for everything. Everything is calculated off the full retirement age benefit.
Pivot number. And the general idea, what most people consider who kind of know some level of what the spousal benefit is that the lower income earning or the lower paid into Social Security spouse, they get 50% of the higher income earning spouse. So here's the numbers that we're going to look at. We're just going to assume Alex and I, we're a married couple, right?
Oh, so that would be a mess.
I feel bad for you, Alex.
Joe could give you some warnings.
We're a married couple. Alex has been the higher income earner throughout our lifetime. So what Social Security has calculated for her benefit is $3,000 a month when she files at age 67. What my calculation is $500 a month, assuming I file at age 67. Now, if you're listening to this, it's like, well, wait a minute. Half of Alex's Social Security is $1,500, not $500. So where are we getting this? Okay, this is where we get into the nuance of this spousal benefit. Because even though my benefit is $500 a month, when I file at 67, also assuming Alex files at 67, I'm going to get an additional $1,000.
Right.
So how this looks like in practice, like the logistics of you actually getting that deposit into your bank account, I'm going to see $1,500 and Alex is going to get $3,000. That's how this is going to look like. But on the back end, the $1,500 that I receive is actually split up between two amounts.
Yep.
The benefit that I had calculated of $500, and then the spousal benefit
of $1,000,
which is $1,000.
Right.
And the reason why I'm pointing this out, because now we understand how that flows logistically. Because if I were to file early,
yep.
If I filed, let's say at age 62 or 65 or whatever, what's going to happen? It's going to reduce my benefits.
Yes. And if I have not filed yet, you can't get the extra $1,000 spousal anyway. So they can't reduce that yet. But your $500 is going to get whatever reduction is appropriate for how early you file below age 67. So if you file at 62, it'll be 70% of the $500. Or if it's at 64, it'll be 80% of the $500. When you file the spousal, which if we're married, you have to wait for me to start my benefit. And if we're the same age and I wait till 70, you don't start your spousal till 70. So that's part of the calculation and the trade-off.
Important to note there too is if you delay till age 70, my spousal benefit is not based on
go up.
your increased benefit that you receive at age 70. It's still based on that $67
Correct.
amount. Okay.
Correct. And that's a good point to bring up. But let's say I only wait till 67 and we're the same age and you're now at 67, you got the early and you got 300 of the 500. Well, now you're going to get the 1,000 and it'll be 1,300. It's not half.
Correct.
Because a portion started early. If I'm a couple years older than you and I start at 67 and you decide and you kick on the spousal at 65, your 1,000 will now be reduced because it was taken before age 67. It's two columns that they're looking at, and it's confusing and it's not typically explained very well. It's difficult to explain without looking at somebody's exact numbers and drawing it up, but it is how it works, and it doesn't mean that the person at Social Security can explain it to you correctly either.
I think that's an important thing to note too, is that when you file
you can get a lot of wrong information.
You can get wrong information, and it's kind of a crapshoot of who you're actually getting this information from. But additionally, you have to know the questions to ask.
Yep, because they can't volunteer it.
They're not going to give you some consultation time. It's like, no, they're there to essentially be an order taker, or answer direct questions that you have, which are kind of like black and white answers, not left open to interpretation. So
they won't give you advice. They'll answer questions. And the other caveat I do want to bring up is in a divorce situation, if you were married 10 years or longer, you are, if you're not remarried, entitled to a spousal benefit on your ex-spouse. If you had 3 marriages that were all 10 years or longer and you're not married to somebody else at this point, you can pick which one you want. And the other thing is they don't have to have filed. As long as you've been divorced for 2 years, you can file independently and get the full spousal portion. So you don't have to pay attention if they're filing or not. They won't even know you filed. You're not reducing their benefit. You still have that ability to file.
So this it's so important to understand the sequencing of filing especially if there's an age difference or there's a big gap between one spouse's Social Security benefit and the others, because it just opens up the planning opportunities from a tax standpoint, from a longevity standpoint, from a tax consideration, from all of this, like whether delaying makes sense for one spouse, maybe taking Social Security early for the other spouse makes sense, maybe both filing at full retirement age, understand the spousal benefit, that there's impacts based on when that one spouse would file and when the other spouse would file. Quick question for you, Alex.
Yeah.
So let's imagine that same scenario. You and I we're kind of coordinating our spousal benefits between each other. If I were to file
the lower
let's imagine, because on my full retirement age is 67, we assume that it's 500. So let's assume that I file at age 62. When I file at age 62, or let's imagine a different scenario so this really makes sense. Let's imagine you're a little bit older, right? So when I turn 62, you turn 67. Okay, so you file yours at $3,000 a month. When I file at age 62, can I just turn on my benefit and delay the spousal benefit until I hit age 67.
Technically you can, but you have to be really specific that's what you're doing, because they'll automatically do both unless you ask for otherwise.
Because in that scenario, if I were to turn on both, then obviously I'm getting a reduction on my benefit, and I'm also getting a reduction on the calculated spousal benefit.
Yeah.
So
but your survivor benefit will still be the higher one.
Exactly. But then if you could turn on your Social Security benefit or mine, let's say it's a reduced amount, I don't know, $300, but that $1,000 benefit, I could keep kicking down the road and actually get it all when I file at age 67. So just even painting these hypotheticals, I hope that you're getting this picture painted of, wow, it's
so many options.
It's not black and white, and there's special situations that certainly warrant a deeper dive. And again, we're really talking about Social Security in a vacuum on its own, right?
Yeah.
Like that's part A, and then part B on top of that analysis
everything else
should be everything else that you have. So then you can come at the conclusion from cash flow, from expenses, from tax headwinds. It's all part of this cohesive picture. Make sure you're getting the right guidance. This is The Real Money Pros. We'll be back.